Okay, let's jump right into this. Today, we're unpacking an industrial giant that's sitting on a problem most investors would absolutely love to have. Parker-Hannifin just reported a virtually flawless fiscal year, but it presents us with a major valuation paradox. So in this explainer, we're going to figure out, is this stock a brilliant compounding machine, or is it actually a brilliant trap? Right now, Parker-Hannifin is firing on all cylinders. I mean, they aren't just growing. They're literally setting historical benchmarks. Looking at their fiscal 2026, they hit an incredible 8.3% jump in sales to reach a record $21.5 billion. And what's really impressive here is that 6.6% of that was purely organic growth. They are just absolutely thriving operationally. Now, revenue is great, right? But as we know, cash is reality. And Parker brilliantly illustrates this by pulling in a massive $3.9 billion in record free cash flow. That gives them an 18.2% margin. When you've got an industrial business converting that much of its sales directly into free cash, you are looking at a highly optimized operation. On top of all that, their future looks incredibly secure. They ended the fiscal year sitting on a staggering record backlog of $12.8 billion. Think about that for a second. That means before they even wake up in the morning to sell a single new part, they already have nearly $13 billion worth of demand lined up and waiting across all their major segments. But here's where we kind of have to hit the brakes. When a stock is already trading right around $1,000 a share and the company is in the middle of a super aggressive acquisition spree, we've got to slow down. We have to ask the difficult question, are we paying way too much for greatness? Does that massive price tag already assume a future of completely perfect execution? Section 1, a $1,000 paradox. So the crucial thing we need to figure out is why a company with a near-perfect operational record might still be a dangerous trap for eager investors. To get that, we first have to understand what makes them so successful. You see, Parker-Hannifin's products aren't flashy consumer brands. You're not going to see their logo at the grocery store. Their products are highly engineered, critical components hidden deep inside complex systems. We're talking motion control systems in commercial aircraft, hydraulics and heavy machinery, advanced filtration, automation tech. They are literally the invisible footprint powering modern industry. Because these specific components require immense engineering qualification and just absolute reliability, Parker enjoys an incredibly durable competitive advantage. It's a textbook moat. Once a Parker component gets engineered into, say, a defense aircraft or a massive factory floor system, it becomes highly risky and ridiculously expensive for that customer to switch to a competitor. So customers stay locked in, often for decades. What's really fascinating here is the sheer visibility this gives investors. A huge chunk of their recent success is fueled by a booming aerospace segment. Just look at this number, an $8.5 billion aerospace backlog. In their fourth quarter alone, this segment produced $1.9 billion in sales with an incredible 29.8% adjusted operating margin. And because aerospace has such long product cycles, investors get a very clear, reliable line of sight into future revenue. Section 2, the $12 billion bet. Now, Parker isn't just sitting back resting on that industrial moat. They are aggressively betting their capital to reshape the whole company. They aren't making small tweaks. They've committed roughly $12 billion in major acquisitions. We're talking Curtis Instruments for about $1 billion. They agreed to acquire Filtration Group for a massive $9.25 billion, plus picking up CIRCOR Aerospace for $2.55 billion. They are betting heavily that their internal operational playbook, which they call their win strategy, is going to integrate these massive purchases smoothly and just drive margins through the roof. But look, acquisitions of this size, they can create enormous shareholder value, for sure, but they can also completely destroy it if a company overpays or messes up the integration. With almost $12 billion on the line, we've got to ask if their cash generation can actually support this high-stakes empire building without completely crushing their balance sheet. Fortunately, the data paints a really reassuring picture on this front. They generated $4.4 billion in operating cash flow, but more importantly, they grew while significantly deleveraging. Management actually reduced net debt by about $1 billion in the fourth quarter alone. They finished the year with their net debt to adjusted EBITDA dropping to a very healthy 1.4 times. Basically, that means their debt is highly manageable compared to the cash they bring in. They're literally printing cash while simultaneously cleaning up their debt. Section 3. The Warren Buffett test. Since the underlying business is undeniably strong, we need to apply a Warren Buffett-style framework to understand the true risk here. And honestly, that risk is almost entirely centered on the valuation. After a brief dip earlier in August from a high of nearly $1,100, the stock settled around $1,039 by late August. So that's only roughly a 5.5% decline from its peak. This isn't some dramatic collapse offering us a rare, once-in-a-lifetime buying opportunity. The business remains incredibly strong, which means investors just aren't getting any sort of dramatic discount. And when we break down that $1,000 price tag, the math gets kind of challenging. If we use management's own fiscal 2027 adjusted earnings midpoint guidance of $34.75, you're paying roughly 30 times forward earnings. You really have to ask yourself, how much future perfection is already baked into a multiple of 30? So, when we grade this out using a Buffett-style scorecard, Parker-Hannifin scores perfectly on having an understandable business, incredible cash generation, and a durable competitive advantage. The moat is very real, but it flashes a massive glaring red warning sign on valuation and margin of safety. It's the classic dilemma, right? A phenomenal business, but a highly questionable entry price. Section 4, Bull, Base, and Bear. Let's explore how this premium 30 times price tag could actually play out across 3 scenarios. In the bull case, everything goes perfectly. Aerospace demand remains incredibly strong. Those $12 billion in acquisitions integrate flawlessly without a single hitch. And, most importantly, they achieve their stated long-term target of hitting a 30% adjusted segment operating margin by fiscal 2031. If they manage to pull all of that off, the compounding cash flow easily defends today's hefty valuation. Now, alternatively, the base case suggests that the company just continues to perform exceptionally well. They hit their expected 5.5 to 8.5% organic growth, the cash flow remains robust, but because investors already paid a massive 30 times forward earnings up front, the actual returns on the stock end up being incredibly ordinary. It's a situation where you bought a great company, but you paid too much for the ticket to ride. And then, of course, there's the bear case. And this is absolutely crucial to understand. The bear case doesn't require Parker-Hannifin to fail as a business, not at all. It just requires industrial demand to slow down a little bit, or maybe acquisition integration hits a few speed bumps, causing debt costs to rise. If that happens, the broader market might suddenly decide that 30 times forward earnings is just way too expensive. The business survives just fine, but the market's willingness to pay a premium vanishes. And that results in a painful multiple contraction, where the stock price simply shrinks, even if the underlying business is completely fine. Section 5. The final verdict. So after digesting the record cash flow numbers, the massive billion-dollar acquisitions, and that lofty 30 times valuation, where exactly does this leave us as focused investors trying to make smart decisions? Well, we have to ruthlessly separate the idea of a great company from a great investment. Yes, it has record cash flow. Yes, it has an impenetrable industrial moat and a stunning 70-year history of paying dividends. It's a flawless compounding business. But a great investment absolutely requires a margin of safety. It requires paying a reasonable price for future earnings, so you leave yourself a little room for error. Ultimately, paying for every single dollar of future owner earnings at this premium level kind of changes the dynamic. It means that right now, Parker-Hannifin looks much more like a masterclass company to study and learn from, rather than a stock to just blindly chase and buy at $1,000 a share. Which leaves us with the ultimate open question to ponder for our next explainer. If $1,000 is too high to provide a safety net, what exact price per share would actually make this incredible moat-building business a genuinely safe and lucrative investment? Well, that is the billion-dollar question we'll be tackling next time. Keep learning, and I'll see you in the next one.